Four stocks I'm planning on buying this week. Like most of you, I put money to work every single week. So every single week, I'm looking where to put that money into. On today's episode, we're going to take a look at four stocks. All of them are hitting different markets. Like always, we're going to take a quick look at technicals. We're going to look at valuation metrics, fundamentals, and just what each company does. The first company we are going to take a look at is Playstudios. This is in the gaming market, and this is a market I'm very bullish on. In my previous weeks, I've talked about stocks within this market, but more mature companies. This week, I want to focus a little bit more on a growth player in this market, and that is Playstudios. So Playstudios, they have a lot of mobile games right now, where the special thing about them is when you play their games, you get points, and those points you can use for real life rewards with their partnerships. They have partnerships, for example, with MGM. So if you play Vegas slot and you accumulate a lot of points, you can end up getting free rooms in Vegas and stuff like that. One of my friends actually uses this platform and uses the game to get some of the real life rewards, and that's before him knowing I was even thinking of the stock. So my Playstudios is currently traded under the Nasdaq as ticker MYPS. It's currently down a nice amount. This was a previous SPAC, and the merger and acquisition has been completed. From its 52-week high, the stock is down 39.98% as I am recording this episode. Like I mentioned, this is a super small company, $889 million market cap. So Playstudios, if we take a look at their most recent earnings, it was up 27.1 compared to same time last year. So we can see strong growth. They are also releasing new games constantly. Their most recent one was My Vegas Bingo. The second one they are releasing later this year is going to be a whole new genre that they're entering, and that is the RPG genre. And that's going to be with Kingdom Boss. And I really want to see the type of rewards they have with this game. So another thing, Playstudios is profitable in adjusted earnings, and they're also profitable in net income and GAAP net incomes, which is super impressive for a growth company. If we take a look on June 25th of 2021, they did enter a new $75 million revolving credit facility. This is going to help support the company in future growth initiative. It's not like they need the money. With the previous merger, they already had a nice amount of cash position and no debt to their name. So again, this just allows them to have more liquidity just in case. Other things I'd like to talk about is in June 3rd of 2021, they extended their partnerships with MGM Resorts International. Again, I really do like there are some big players using Playstudios at the moment. And I can't understand why people aren't talking about this stock, which is expected to grow at strong levels. And like I mentioned, profitable in adjusted EBITDA earnings and in GAAP earnings. If we take a look at the second company, but before we do that, guys, let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. And also, I am going to post right here my previous four stocks that I purchased last week. Feel free to check out that video later. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services the Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. So the second stock is Redfin. You might know this as the real estate online marketplace. Most of you guys has probably used their websites to either look at houses or just be nosy what your neighbor purchased for their house and so on and so forth. So Redfin is definitely pretty interesting right now. We all know, right? If you have been looking at houses right now, it's pretty much a pain. House prices are off the roof. They're selling like no tomorrow. Redfin is traded under the Nasdaq as ticker RDFN, is currently sitting at $62.48. From its 52-week high, the stock is down a nice amount. It's down roughly 35.31%, and it currently has a market cap of $6.5 billion. Some recent news about Redfin, they share a lot of information about the overall real estate market to their consumers, which I think is pretty cool. Median home sale prices have increased 22% compared to the same time last year. Asking prices of newly listed homes were still up 12% compared to the same time last year, and pending home sales were up 17% compared to the same time last year. So we can see the market is still somewhat very hot, but it does seem like it's starting to cool down a bit. Mortgage purchase applications have decreased about 1% week over week during the week ending of July 2nd. A good reason, right? The house prices are too high, so people are like cooling off right now, waiting for more houses to enter the market or prices to decrease. Regardless, I do think Redfin will be a good player if it's either a seller's or a buyer market. Redfin right now is expected to grow 26.6% on average for the next 3 to 5 years. So huge hyper growth stock. They are not profitable in GAAP earnings. Almost there, but they are positive in cash flow from operations when taking a look at trailing 12 months. And that's something I'm super excited about. Their balance sheet, it could be a little bit stronger, but I don't mind it. They have $1.4 billion in cash and $1.2 billion in debt. So they're not leveraged right now, but I do wish they had a little bit more cash or a little bit less debt. The third company we are going to take a look at is Teledoc. This is in the telemedicine. I mean, I hate going to the doctors. I prefer to do everything online. So telemedicine is a market I believe is here for the future. Not a market that was just doing well due to COVID and lockdowns. I do believe it's going to be pretty strong. I'm pretty sure most of you enjoy it. But we can see from its 52-week high, the stock is down about 46%. This is insane for such a big company, right? Right now, the market cap is $24.5 billion. Just that overall excitement, but I do believe now is providing a good portion or a good, definitely a good buying opportunity for me if I want to increase my telemedicine exposure. Teledoc, if we take a look at their most recent earnings, they did raise their full year guidance as first quarter revenue grew 151% compared to the same time last year, with total visits increasing 56% compared to the same time last year. So one thing, like I mentioned, a lot of people are not liking Teledoc because they believe the company or the overall telemedicine is going to go away or decrease after lockdowns. So this is something we've seen a lot in the past few weeks. Analysts kind of reducing their price targets. We've seen this one go down to 163 from 217. This one go down to 252 from 270. And this one go to 250 from 270. Again, I don't normally follow analysts, but I do believe it does create some form of short-term movement for the stock. Teledoc right now is expected to grow 23.4% on average for the next 3 to 5 years. They are not profitable or positive in cash flow from operations when looking at trailing 12 months. This is a bit scary. Most of it has to do with the expenses they kind of accumulated with their Livongo acquisitions, which I believe was a great acquisition, and how this company is going to continue to grow in the upcoming years. Teledoc, their balance sheet also doesn't look that strong when looking at just cash and debt. They have about $700 million in cash and $1.4 billion in debt. So you might be like, Jose, why are you showing this stock? Why are you looking into buying it if they're not looking good in fundamentals and in balance sheet? Again, most of it has changed because of the acquisition, and I'm very bullish in the overall telemedicine. At the same time, my Teledoc exposure right now is super small, so I don't mind increasing at these levels. The final stock we're going to take a look at is one in the EV market, right? I'm super, like the telemedicine, I'm bullish in the EV market. I just have such a small position right now that I wouldn't mind increasing my exposure on Tesla. So Tesla, it is currently traded on the NASDAQ as ticker TSLA. From its 52-week high, the stock has definitely seen quite a correction as well. 25.4%, and it's currently sitting at a market cap of $632 billion. Some recent news they did kind of give us on July 2nd, their full vehicle production deliveries, and it's insane the amount of numbers and growth they're still seeing. Production for this quarter was 206,000. Deliveries were 201. Compared to last quarter alone, last quarter was 180,000 production and 184,000 deliveries. And now if you compare it to same time last year, it's insane growth. 82,000 in production last year and 90 in delivery. So over 100% growth compared to the same time last year. Tesla fundamentals look pretty strong, expected to grow 23.5% on average for the next 3 to 5 years. So strong growth company. They are profitable in GAAP earnings. They're also positive in cash flow from operations. A lot of bears may be like Jose, but they're only profitable in earnings part because of credits. That is true, but unfortunately, that is the way the market is going right now. And regardless, they have been positive in cash flow from operations beforehand. I know there's other EV players out there, and I do have a few others out there, but I do want to increase my exposure in Tesla right now. If we take a look at balance sheet, they have $17.1 billion in cash, $9.4 billion in debt. So not leverage at all, which is what I like to see. Now let's jump into technicals. I just want to make sure the stocks are not overextended. I do believe if they are overextended, my overall risk increases a bit. It doesn't mean it's a bad investment. I just believe the chance of a pull down is a bit higher. Playstudios, we can see definitely not overextended. It has definitely seen quite a pull down, and I believe at these levels is a really great buy for me. Redfin, not overextended at all, sitting at near its moving average. Again, a good portion of the risk I believe has been eliminated. Teledoc, similar, not overextended at all. We saw this price go up a nice amount earlier in the past few days, past week or so, and kind of pull back down, again giving investors a bit of buying opportunity if they want to see a long-term investments in the telemedicine world. And finally, Tesla, very similar, not overextended. This doesn't mean the stock prices can't continue to go down. There's always the risk. I do believe just that risk has kind of decreased a bit. Now I want to take a look at forward price to sales ratio for these three companies. If we take a look at Teledoc right now, 9.4. These are levels kind of seen in the late summer of 2020. So good, I believe, again, it's not overvalued right now. It's kind of sitting at levels a year ago, which I think is pretty good. Redfin, almost the same thing, right? Sitting at price to sales ratio of 3, sitting at levels seen in the second half of 2020. Again, not bad. Tesla might be the only one that still looks a bit expensive right now. Unfortunately, Playstudios is such a new company that there's not too much information right now. I do believe, right, I don't purchase all 4 stocks, and if you guys want to know what stocks I purchase, make sure to join the Discord. It's free. But these are the 4 I am going to be looking at. I might purchase 2 or 3. I think at least the one for sure is going to be Playstudio. Is looking super cheap right now. And then the other 2 that I might purchase, or the other one I might purchase, it could be any of these 3. But I do believe any of them would provide great value for me in the upcoming years. So I hope you guys enjoyed today's episode. Take care, have a good night, and see you next time.